To our financial literacy class today. We're going to talk about investments, instruments, and risk management. So let's go directly. So by the end of this lesson, you should be able to answer the following question or understand the following questions of what are investments, the types of investments that are there, and why do people invest, or you as a student invest. So let's go directly to introduction to investments. In other words, it's another way to move consumption to the future. It is an asset purchased with the idea that the asset will produce income in the future or will be later sold at a higher price for a profit. Ideally, the investment should be providing income or profit in the future. For example, you cut your current consumption to purchase stocks and anticipate stock prices that will rise in the future. Next, we go to the characteristics of investments. Number one is returns. Investments, their primary objective of investments is to generate returns. This is in form of yields or in form of capital appreciation. Also, the return from investments, it depends with the nature of the investment, which type of investment are you investing in, and the maturity of the period. The second characteristic is risk. Risk is inherent in any investment. All investments have risks. This may relate to the loss of capital. As all investments have risk, it may result or relate to a loss of capital. We have liquidity. At number 3, it is an investment which is easily sellable. In other words, it can be easily converted into cash. Most investments on financial assets are also liquid in nature. Let's go to the next types of investments. There are different categories of investments. As you can see from the diagram above, it has helped you simplify the types of investments. We have stocks, we have bonds, we have mutual funds, we have exchange trade funds. We have alternative investments such as real estate, commodities. We have also savings or certificate of deposits. In our coursework, we're going to talk more about the common financial types that are stocks and bonds. That's our major type of investment. As you can see, we have stocks and bonds. Let's go to the number one, stocks. It represents ownership of a corporate business, an investment that represents ownership of the company or corporation. In stocks, the gain in shareholders typically comes in the form of either dividends, in other words, regular payments to others, or appreciation in the value of stock. So when the shareholders gain income from their dividends, also stocks have high rate of return, and having high rate of return means a greater risk. The higher the risk, the higher the rate of return. Stocks also provide portfolio diversification. We have bonds. They provide business, governments, and other organizations with a convenient way to borrow money. Bondholders are promised regular interest payments and repayment of the principal amount. As long as the issuer remains solvent, the payments are reliable. Also, bonds are issued at a particular interest, which is known as a coupon. A coupon is a particular interest issued when you have a bond. The rest is fixed, and on most bonds have a fixed coupon rate. We have mutual funds and exchange trade funds. These are pooled money from investors to buy a diverse range of assets such as stocks, bonds, and real estate, providing easy diversification and reducing risk. Investing in equity mutual funds, which buy stocks from various companies, it helps investors diversify and lower their risk. Also, regular contributions to an investor portfolio over a long period can yield high returns and less volatile or risky. So, advantage of mutual funds, we have the diversified, which means the spread of risk, thus minimizing the risk. Also, another one, you can select different risk levels. We have cons or disadvantages. In other words, we have return isn't guaranteed. The return of mutual funds cannot be guaranteed since you don't know when and where you're going to receive them. We also have subject to expensive management fees. It is costly, hence expensive. At number 4, we have alternative investments. It includes real assets, commodities, private equity, and hedge funds. These investments, they have a lower correlation to traditional investments. Traditional investments are the bonds and stocks, which provide diversification benefits. However, they carry higher risk and may have limited liquidity compared to publicly traded securities. We have now we go to the next question. Why do people invest? Or why will you invest as a student? Now, the number one is concept of compounding. In other words, returns on investment. We invest in order to gain returns. So if you keep money invested in the stock market and reinvest all in the gains that you get, is compound interest. It is simply earning interest on an interest. For example, if you don't spend interest earned by your savings this year, the interest will add both to your savings and the interest earned next year. By doing the same thing each year in the future, you then earn an interest on your interest. It's like a snowball rolling down a covered mountain. It increases in size slowly. In other words, when you invest your money this year, let's say, as for example, in our snowball effect, we have $5,000. This year you decide to you get an interest of $5,000. You add both your savings and the $5,000 interest. To the next year, it will generate $10,000. The next year, it will generate $20,000, and the next $40,000. As you can see, it is increasing in size. This is the snowball effect. We also, as you can see from the diagram, it will help you simplify and gain more understanding. Where you earn, you reinvest, you earn again, you invest, earn again, and then reinvest. It is a continuous cycle. That is the compound interest or the return on investment. We have at number 2, we have hedging against inflation. Hedging helps the investor protect them against rising prices and the fall in the purchasing value of money. That is why you, as an investor, decides to invest. It is to hedge against inflation. At number 3, we have we have the investment process. We have 7 steps. The first one being setting financial goals, assessing risk tolerance, creating a budget, diversifying your portfolio, conducting research and analysis, making informed decisions, reviewing and rebalancing of the portfolio. Let's discuss this process steps by step. At number 1, we have setting financial goals. This involves determining your objectives, such as saving for retirement. For example, your parents can invest to save for retirement. We have considering your time horizon and risk tolerance. When you set financial goals, you consider the risks that will be there. Also, at number 2, we have assessing the risk itself. You assess the risk, if it will withstand the investment. If you as an investor can withstand the potential losses. You also have to understand your comfort level with fluctuations in the increase in the value of your investment. We have number 3 at creating budget and emergency fund. You have to develop a realistic budget to allocate funds for investment. We also have establishing an emergency fund to cover the unexpected expenses. Emergency funds are to always cover extra or unexpected expenses that incur during the period. At number 4, we have diversifying your investment portfolio, which involves spreading your investments across different asset classes, sectors, or industry. This helps reduce risk through diversification. At number 5, we have conducting research and analysis. Involves gathering information about investment options. Before you invest, you have to know the options, the market trends, the economic conditions, analyze the financial data, and make decisions based on your research. We have making informed investment decisions. After conducting the research, you select appropriate vehicles based on your goals, risk tolerance, and research. The best decision you've come up with, you're going to use it to allocate your investment funds accordingly. At number 7, we have regularly reviewing and rebalancing of the portfolio. Monitoring the performance of your investments. It involves adjusting the portfolio as needed to maintain a desired risk-return profile and asset allocation. In other words, you have to look at your investment every now and then to review it and rebalance it where needed. You adjust according to the way the market is going. So thank you. This is the end of our part 1 video. Next, coming up, we'll have our part 2 on financial instruments. Thank you so much.